Welcome back, everybody. Sive Morten here with forexpeacearmy.com. Today we consider a couple of moments. First, just brief look on the report that we have prepared today. Fundamental report, a lot of interesting stuff there. Despite that we haven't got the major driver and payrolls, there are lots of interesting data and actually indicators that could make us some midterm forecast for the euro currency. And second, as usual, of course, we'll take a look at the short-term technical picture, what we intend to do on Monday. So first about report. So we have estimated a few driving factors that might be extremely important for euro and for the dollar, of course, in the nearest 2 or 3 months. And I wouldn't call it as a super strong drivers, but we could identify them as a pressure drivers. So by our view, due to these factors, United States dollar will remain under the pressure in the nearest 3-4 months, maybe in the fourth quarter of 2025. Among of them, we could call the narrowing of the real rates. It's already talked about this. More dovish position from the Fed, especially if we take into consideration the impact of the shutdown. If it will last for example 1-2 weeks, it will be already more or less significant term. Then is a more in the cheaper hedging of the United States dollar weakness that could lead on acceleration, taking the hedging short positions against the United States dollar, and a few other reasons. So taking in consideration all these factors, we suggest that overall tendency on the euro currency should stay intact, and we still consider that euro currency should return back to the 120, maybe even slightly higher levels in the fourth quarter. So actually, not only we think about this. If you read the recent update from the UBS about the review in the euro currency, we are shared with this report from the UBS in our Telegram channel, so you can find it there. They're approximately telling the same, although they set a bit higher target. They talk about 123, but in general, it's very close. Now, let's take a look what we have from the short term. In fact, longer term charts, monthly chart, weekly chart is absolutely useless right now because market stands in a very tight range. We do not have lots of drivers. We have lost the payrolls report, so that makes market consolidating in a very tight range. That's why if you take a look at the monthly and weekly chart, you will not find anything there, except maybe on the weekly chart. What I would like to say, on the first glance, everything stands the same. We've got inside week, so making no impact on the overall picture. But take a look that after collapse from the 119 area, the downside action is slowing down. So actually it returns back into some range that was standing here previously. And this is not typical for bearish markets. Usually bearish action develops faster than the bullish, and it's relatively fast, especially when you have in place some bearish pattern. First reaction was great, but now it's slowing down. And what I would like to say is that if it will last for another 2-3 weeks and market will stand here, it starts taking the shape of the bullish dynamic pressure. Because take a look, trend stands bearish, price action is not quite bearish, especially here. So it might add to some bullishness, which is actually corresponds to our fundamental view based on fundamental analysis. Weekly chart is very close to fundamental analysis because it's long term, and it could confirm this idea. In the shorter term, on the daily chart, once again here is inside session. Nothing interesting. Now a discussion of the Great British Pound, the hand-shoulders pattern now has actually more sense than taking a look on the euro currency. What we could say about overall picture? Well, let's start from the nominal points. Nominally, trend remains bearish. And following this idea, the pattern that we could suggest, for example, might look like this. So on the 4 time frame chart, potentially we could consider the butterfly. Theoretically, it could be formed. At least for now, the shape is possible. Although, guys, to be honest, I am not sure with this pattern. I am speaking not about the shape. The shape is perfect, but in terms that it's really will start working. Because if you take a look once again on the Great British Pound, I will show you the patterns that we were considering. Take a look first on the hourly chart. Here's the hand shoulders, obviously, is skewing to the upside, which is right arm seems higher. And that might be the sign that it is failing. If these hand shoulders will fail, as we said, if you remember in our discussion on Friday, then probably this should work, right? So at least market should complete the right arm, returning back to an area around 135.15, 135.10. So where this will be the neckline. And if we will get the clear bullish reversal pattern on the Great British Pound, correspondingly, it's very difficult to unite it with the bearish pattern on euro currency. If, of course, we're not talking about some specific driving factors between the United Kingdom and in Europe, which is actually currently not the case. So we're talking about relation to the United States dollar. Correspondingly, it means that either this pattern has to fail later, so market should start dropping here, or maybe here's butterfly also start forming, or definitely this pattern will fail. A lot of uncertainty, right? So difficult to make the decision. The one attractive point here is that price stands very close to invalidation point. In fact, this pattern is valid until market stands below the top. It's 117.78, and here market relatively close. So that's why what I'm offering. Let's take a look what will happen on Monday. If you take a look at the hourly chart, where we have some kind of the garbage triple to sell, and we have two bullish grabbers in a row right there. Both suggest action above 1760. What does it mean? It means that if they will work, the market appears at this point, it will be very potential small loss of the potential bearish trade. So it will be less than 20 pips in this case. So that might be an important factor for making decision on position taking. So we could say, yes, we're not sure, but risk is very small. And from that standpoint of view, let's take some, maybe not the full lot for trading, some part of the lot trying to deal with this position. What if it will work? This is one of the logic that could be applied here. Second moment is, anyway, we should get some progress, and maybe we will see something else. I don't know what it will be. Maybe this will be kind of the hand shorts here, something like this. Maybe some other moments will happen. I don't know. But we will get a bit more information and we'll make the decision on what to do. Would we like to take the short position here or not, or we start watching for a bullish position instead? So that's the overall logic. First, let's let these driving factors, these grabbers, to work, and then when the potential risk will be minimal, we will take a look once again on this picture and make the decision. So return back to this question on Tuesday.